All right, welcome everybody to this week's edition of Self Wealth Live, the technical analysis edition. Here with me, Roger from Self Wealth, and Jason McIntosh from Motion Trader. Hi, Jace. How are you?
Hey, Rog. I am good. Looking forward to another show with you. Talk about some charts and see what's going on in a few of these markets.
Yeah, fantastic. Good to see. And welcome everyone today to our show. Hopefully we can answer some questions, talk about the markets in general at the start, and then have a look at your tickers as well. And I just want to go over some of a point that I was looking at some social media this week, Jace. I don't often look at social media, but I look at social media every now and then, and something really just struck my heart, to be honest. So we'll go over that, and I'll ask you that question later on anyway, Jace. But before we do, hi, Michael, welcome. Can we have a look at our disclaimers, please?
Well, I'm really looking forward to this question you got about social media, Rog. You got me intrigued. But before we get to that, I'll go over this disclaimer. So everything today, general commentary only, doesn't take anyone's personal situation into account. And we just put this up for a moment. The other important thing is I'm not part of Self Wealth. I'm from Motion Trader, and you can see all my details in that top section, licensing and so on, and the same for Self Wealth in the lower section, licensing and so on. No personal advice, all of that, general commentary only.
All right, fantastic. Okay, so so before we get on to the regular show, I was trawling some of the forums around the ASX on Facebook throughout the week, and I noticed some of the questions from, whether they be beginners or people that don't have much experience, obviously. And I'm not to say that I've got a lot of experience, but I do have a little bit of experience, right? But one of the things that makes me proud about this show, and next week will be 1 year we've been doing this, Jace, believe it or not.
Really?
So,
wow.
Yeah, 1 year. So one of the things that makes me and want to keep on going as well, as obviously I get to chat with you each week, which is great, but it makes me think that we are actually giving some great education, not around the ASX, not around but more around having systems in place, right? Because I've seen multiple people say, hey, I bought this stock, now it's doubled in price, and they're asking random people on Facebook, what do I do with this stock? I didn't even know it was going to go up twice. I didn't know it was going to double up in price. What do I do now? Do I sell it? Do I hold it? What am I doing? And then you have all, out of these groups that have got thousands of members in them, you might have 7 or 8 comments giving different opinions to people. Do you think that person is better off getting all those 7 or 8 opinions from that other people? Or do you think that person is better off having a system to follow in which they can handle these stocks when they buy them? Now, I know this is a rhetorical question, obviously, Jason.
We could take this in so many different directions. It's first thing to be better off doing would be logging off the forum and going to Amazon and buying a book. Buy a book on, and this is open as well, because there's so many different ways you can approach the markets and trading. There's not like one go-to book, so it's not quite as simple as just do that. But the first thing I think we've always got to consider when we have a stock that's gone up 100% is what I've done repeatable? And the easiest way to figure that out is you say, okay, write down your process on the back of an envelope. Just tell me why you're buying, why you're holding, why you're selling, and how you're deciding how much to risk. If you can't answer all of those questions, well, you don't have a repeatable process. So it's a bit of like, sometimes you just stumble into a stock that does well and you hold and it goes up like, wow, that's great. And then you're on the forum going, well, what do I do next? No process. So it's not repeatable. So it becomes like, well, I can have a win down at the local Star or Crown, and it's not repeatable either. It's it's harsh to put it that way, but really, I think we've all got to think, do we have a repeatable process? If we don't, we've got to get one. Otherwise, we're just really handing money. We'll make some money, then we hand it back to the people who do have a process. So really important thing. And as for going on the forum and saying, what should I do? You may get someone who's quite really smart, has a great process on the forum, but you don't know that. You don't know who you're talking to. What's the experience behind all these people offering advice? Are they someone who's been in the market for 6 months and had a couple of wins and thinks they've got 30 years experience? Or is it somebody who does have the runs on the board? But you can't necessarily differentiate that from just a few lines of commentary, like who's providing the information. I think that's a really important thing when you're looking for someone to help with mentorship and helping you with the markets. What's their background? Do they have the runs on the board? Do they have the experience to back up what they say? And when we're behind the anonymity of the social media, you can't really tell. Lots of people will tell about their big wins. You don't hear about the losses behind the scenes either. So it's a hard one to gauge. So I'd say work out how you want to approach markets, spend some time looking for the right books, the right mentors, and that's how I'd play it.
Yeah, of course. And I think one of the reasons why I started joining some of these forums is just to check out some of the pain points people might be having. As the beginners or even intermediate people, what kind of questions they're asking, right? But when I see some of these things, I think once again their issue is never what stock to pick, or it's always how random people do things. Now, if I think about once again comparing trading to, let's say, the Olympics now, right? The Olympics, do we think that the Olympians have a system in place, they have a schedule in place, they have a training system in place until they get to the main event? Or do they just go in randomly and then, go and ask a mate, what he thinks about this and that and all that sort of stuff, right? So if we compare those two, it's funny how we think that trading's any different. And I think that, or trading or investing for that matter, is any different. If you're a long-term investor, similar thing, having a process in place and a system in place is really important, right? And in any event, it's never the ASX or the problem, or the company that you bought in is the problem. It's the way it's the system that you're using, right? Have you got that repeatable system, as you say? Have you got that simple, easy, repeatable system to be able to continue investing in the markets? I think unfortunately, a lot of these people on Facebook eventually get burnt, right? Or any social media, right? Because like you say, we don't know what kind of experience they might be getting, people getting advice from them. Look, I think they're great as communities. I think having people to talk to about things is great, but I do certainly think a lot of the times, thousands of members in these communities, I don't know how many people, how much value you actually get from these ones where you don't know who they are. I have to say though, Jason, you did get a mention on one of them saying, hey, you'd be a good mentor for these people, right? So for some of these people, mate. Yeah.
I think I think a telltale sign of someone who you probably shouldn't listen to is anyone who speaks with certainty. Yeah. If someone tells you this stock's going to do this, not this stock could do this, or this is a possibility, it's they talk with certainty. The market's going to do this. The market's going to crash. The market's going to boom. It's like no one's got that crystal ball. So how can we say the market is going to? Because you don't know. The market could do any number of things. Now, we can work through the possibilities and we can come up with strategies to play those possibilities and manage risk. But I can't tell you anything with certainty. The one thing you're going to hear for sure today is that I don't know, because I don't know. But that's okay. We don't need to know what the market's going to do. We've just got to have those processes that we can use to identify an asymmetric opportunity. That's where our potential upside is greater than our perceived potential loss. And then having those strategies to put the trade on, to manage the trade, to get out of the trade. That's what I can help with. In terms of crystal ball stuff, well, I'm not your guy for that.
Yeah, fair enough. Well, it's good. Well, I'm glad if you're one of those people that are probably looking for an answer around systems and processes, then this is, we're a good start. And I'll tell you what, some of the stuff that we did at the start of when we started this, mid last year, go back and revisit some of that, because some great training, initial sort of 12-week training on that. And it's all free. But you've got to remember, I've done a lot of paid education around these topics in my life as well. You've got to remember sometimes the paid route is also a very, very handy way to go, because it actually keeps you more accountable to the systems that you're paying for and whatnot, right? So, obviously you can go and visit Jason anytime at motiontrader.com.au. And and obviously trade at selfwealth.com.au when you're executing on the ASX or the US markets. All right, that's enough on this topic now. I hope we're ramming down the point of having a system, because that's what we're all about. Jace, let's start off this week. We'll having a look at the ASX market as it's taken a bit of a, well, we thought it was going up, and now it's coming down again. So
this is really interesting. I think it fits with our theme of how we've started off. So let's go over. Let's get some charts, and so we'll start with that's not the ASX 200 there. This is the ASX 200 here. That previous chart was the Chinese market. We will come to that later on. So this is really interesting. So a few weeks ago, we had an all-time high. Now we're having a pullback. And what I think is interesting here is that when you get a high in the market and you start getting a pullback, a lot of people start worrying that, look, is that it? Is it all over? Was that the top? And so just thinking about some of the psychology that goes in behind the markets, like how we operate within them. And when a market starts to pull back, or this isn't really, I wouldn't even call this a falling market at the moment, it's a market pulling back. But when a market starts to fall away, I think there's often a tendency for people to just sit back and hope it bounces back, and they hold on to their losing trades. And what happens when a market is rising? They tend to, their hope is often switched with fear. And so when we have a rising market like we do now, they switch that emotion of hope to fear, and a lot of people start worrying about a change in trend, and that the top's in and they can't go any further, and they sell their winning trades. And so they tend to get things back to front. I think people would be a whole lot better served by approaching markets in the opposite direction, and that is when a market's trending lower. So go back to a trending lower period. When the market's trending lower, I think what we should be doing is we should be fearful. We should be fearful that it will continue to trend lower, and then we protect our capital. We sell our losing trades. We take less risk. We just pull back a bit. But when you have a market which is trending higher, which has been the case since last October, we should be hopeful. We should be hopeful that the market will continue to rise, that it will extend higher, and we should be sticking with our winning trades. So we've just got 3 weeks of pullback at the moment. It's still an upward trend. So I think people, as I say, better served by putting fear to the side, and we're running with hope at the moment that these trends can extend higher, because that's currently the path of least resistance. So just having a look at this chart, how it's all set up at the moment. So I think it's an interesting juncture for the ASX 200 in that, so we've got a breakout. We've got a breakout from this, got this big 3-month trading range. We had a breakout about 4 weeks ago, an initial rally, and now we're getting the pullback. So as it stands, this pullback to me, it looks corrective. And we've got that classic zigzag structure where I just trace over how we get the zigzag. We've got the leg down, we've got the leg up, and we've got another leg down. So that's your classic zigzag we see so often in the markets. And with the zigzag, we often get the initial sell-off, we get a rebound, and then we get a secondary sell-off, which is what we've had. So that doesn't mean it's over. They can continue to chop around, but that's that basic structure that we get in that type of market. The other thing to note is that prices have pulled back to the breakout points. This is where they broke higher a few weeks back, pulled back to the breakout point. So again, that's some of that classic price action that we often see, that we get the breakout and then we get the retest. So from those perspectives, I think this remains overall. I think this remains a bullish chart structure. But of course, that doesn't guarantee that the breakout is going to stick and the market will go higher. That's what we were talking about before. There's no certainty. It just sets up a positive setup. It doesn't mean it's going to deliver us a profitable outcome. So we've always got to be aware of where things can go wrong. I think I think if this market were to pull back below last Thursday's low, back below the 50-day moving average, it pulls it back into the range, and then I think that would then mean we've got a false break higher, and we get a longer period of consolidation. But that hasn't happened yet. At this point, I think we want to work on the basis that we have a breakout, we have a pullback, and that the odds favour a continued extension in this trend. So at this stage, look, I think we're staying bullish. I think it's also, I think another thing I think is helpful to look at. I think it's helpful to have a look at the ASX 200 on an equal weighted basis. It's something we don't often do. Often people will just look at the ASX 200, which of course will be dominated by the big stocks like CBA and BHP and the other banks, some of the other resource companies and a few others. They tend to really what they do tends to pull the ASX 200. Look at it. This is the ASX 200 on an equal weighted basis. So the bigger stock and the smaller stock have the same influence. And I think what's interesting here is, let me just compress this a bit. So the equal weight hasn't made an all-time high as yet, like the ASX 200 yet, but it does have a what I think is a building structure, in that, like, to me, this looks like we've got like a big basing formation in place over the last couple of years. We've had the initial run higher, which is, you can see this blue horizontal here. That's a resistance band, which the market broke above in March. And since March, this has just been tracking sideways. It looks to me like very much a corrective sort of price action. So we had like the strong impulsive move up from the October low to the March high, and then we've got this sideways consolidation. And often when you get this choppy overlap price action, it's a telltale sign of a corrective phase. And it's also encouraging that it's held on to most of the gains. So from the October low, we've held on, the equal weight has held on to most of those gains with this shallow consolidation. In my experience, these structures typically resolve to the upside. It may still take time to go sideways, but I think the balance of probability lies that this market at some point does push higher. So I think the play is being long the market, using risk management to exit stocks which do start to give too much to the downside, but holding on to profitable positions, see where they can go.
Okay, fantastic. It doesn't look the same on the American market. It's slightly different. It's starting to go down. Let's have a look at the S&P 500.
Yeah, we'll start with the S&P, and well, gravity finally caught up with this. We'd spoken about how the market was a bit above these moving averages, and markets always come back and retest the moving averages at some point. So I've got the 50 and the 100-day averages. So back to the 50-day average. And what was interesting was on Wednesday, so it'd be this day just here on the chart, that was the S&P 500's first 2% down day since December. So you've got to come all the way back to December 2022, that is. So it's all way back. Where was that? Where's December 22? It's somewhere back. Yeah, it's somewhere back over here. That's the first 2% down day last Wednesday since way back on the left-hand side of this chart, which is quite an extraordinary run. We'll come back to that in a little bit. But first of all, just like what's driving this fall in the S&P 500? Why has it come back? And I think the big reason behind it is some of these tech stocks, these big tech stocks which are driving the market. So I just quickly jump to NVIDIA, and you can see it's gone from being stretched above its moving averages, pulled back to the moving average, now closing in on the 100-day average. And it always happens every time. As long as the stock stays listed, it always comes back to the moving averages. So it's just being, it's why I always say be cautious buying stocks when they get stretched above their moving averages. And over the last few weeks, we've been discussing the strategy of not buying into the S&P 500 index, but instead focusing on the components, because of course the index has been heavily driven by these big cap stocks. So by focusing on the components, it's about not chasing these stocks which have run so hard, but instead looking for stocks which are breaking out of ranges, which are rallying off moving averages. And that's been where I think the opportunity has been over the last month or so in the S&P 500. Now, quickly coming back to the S&P 500. Now, just take, here it is here, S&P 500. Now, just take a quick mental snapshot of what this section of the chart looks like. So a strong market and now a decent pullback back to the 50-day moving average. Now compare that. I'm going to jump over to an equal weight. So we looked at the equal weight of the S&P 5 of the ASX 200. Now look at the equal weight for the S&P 500, and you see quite a different situation. It hasn't been anywhere near the pullback we've seen in the market index when you look at this on an equal weighted basis. And the big reason that this is holding up better than the S&P 500 is that it's not being pulled around by those big cap tech stocks. So look at where the equal weight's trading now. It's trading at the same level it was trading just on the 17th of July. Now go back to the S&P 500. It's trading at a level where it first got to around the 14th of June. So the pullback has been larger, and as we just said, it's due to those big tech stocks having more influence in the index rather than the equal weight. Just on the equal weight, we've been discussing this breakout over the last few weeks. The pullback has brought the equal weight back to the breakout point, quite similar to what's been happening in the ASX 200. We've got that retest, also got the 50-day moving average coming underneath. I think this is an important region for the equal weight. I think if this breakout's going to hold, this is where the buying needs to come in. If the price makes its way back below the 50-day moving average, like the ASX 200, if that were to do that, I think it just puts this broader consolidation back in play. But at this point, overall trends up. This is what we have at the moment. It just seems to be a normal pullback within a rising market. And we also have that broadening participation, which is evident by the equal weight breaking out. So it breaks out because more stocks are participating as opposed to the S&P 500, which has really been relying on 4 or 5 or 6 stocks. This broader participation, I think, is good for the market generally. So I remain long stocks, using those wide trailing stops to manage risk, try and see off these pullbacks and consolidations when they arise. And just quickly now, remember how I said that 2% falls, the first 2% fall since December 2022. This is another interesting thing. I saw a news article. Now, if anyone's been watching my weekly strategy sessions, or particularly the one last Friday, you already know this, but for those who didn't, it's worth this quickly looking at. So I saw this article. This is a Bloomberg article. The headline reads, S&P 500 snaps longest streak without a 2% decline since 2007. And it goes on, you read the first sentence, and so the opening sentence, it finishes with ending its best streak without a 2% decline since the start of the global financial crisis in 2007. So in the opening sentence, it's already linked the recent pullback to the GFC. And I look, it's on Bloomberg too. It's not a TikTok feed or something which maybe has less credibility, but I just don't know how helpful these articles are. So anyone reading that is now thinking, look, there's something similar to the GFC. So I'm just going to put all this into perspective. Let's go to a weekly chart, and we're just going to quickly look at this. Also, just if you scroll to the bottom, this shows the length of the current run without a 2% pullback. So like 18 months or thereabouts. There was another period in 2016 to 2018 thereabouts. You can see another long stretch, and then you got this big stretch leading into the GFC. So when you look at the actual data on it, I've actually got the points marked already. So this was the 2016 to 18 period without a 2% pullback, and then we got that 2% decline, and there was a period of volatility. And then, of course, the GFC. This is where the period ended. The GFC didn't start till 6 months later. So are they actually linked? I don't think they are. It's just the market continued on for 6 months without crashing. But nonetheless, this is what a lot of these articles will do. Now, what's interesting, when you go back to the data to 1950, most of the time that these big streaks ended, the market was higher 6 to 12 months later. So I think just be careful. Be careful when you look at headlines with, linking things to events which didn't turn out too well, where they then only use a small sample of information. Because I don't know, Rog, I just don't think they're helpful. I think they're good at getting people worried, but I don't think they're that great at helping us manage our portfolios.
Yeah, but this is the point of what we're actually teaching, though, as well, Jason, is we're looking at the bigger picture. Even the other day, someone said to me, "Oh, the market has gone up." I'm like, "Yeah, oh, well, what? Just one day." If you look at it in a longer term basis, I think we were talking about the NASDAQ and all that sort of stuff, right? So yes, it's been going up, but if we have a look at the chart on the NASDAQ, Jason, can we have a look at the NASDAQ?
No, NASDAQ, yep, we can do that.
I think we had a positive day at some point over the last week. But overall, right now, it's starting to really break down. Even the NVIDIA, look, there's a double top happening up there now, and that's really starting to break down. We're giving people that overall picture of what it's looking like, right? So yes, the NASDAQ has snapped back to the EMAs, like you say now. We're not entirely bearish, but we're not entirely bullish. We're sort of just sitting here waiting for it to play out. But we're showing people the full picture, right? We're not just relying on one headline or instilling fear. We're preparing people to play the markets as they are and what they're going to do next. No one knows, right? But at least be prepared of what could happen, right? So
look, there's the headline's okay. There's nothing with drawing attention to something with a snappy headline, but then I think you want to have things explained in a way that puts everything in perspective, which unfortunately I'm not sure that previous article did, because it doesn't go back to the data and say, hey, but since 1950-ish, these long streaks, when they end, they do tend to lead to positive results. It's just made this linkage to the GFC, which sounds a bit scary if you don't know the rest of the information. So sure, have a headline which gets someone's attention. Nothing wrong with that, but then have the information giving the full picture behind it. I think that's really important. So just be careful when you read an article that it's not relying on a small sample size of information.
Just for curiosity, Jason, at what point if you were to see this break down, this NASDAQ, at what point would you start getting bearish on this index here?
Well, at the moment, it's still an uptrend. At the moment, we just have a pullback to a 100-day moving average, which will happen every 1 or 2 years in an upward trend. It's not an uncommon event. Like we can see another one back in April. This period back in late 23 where we traded below the moving average, the 100-day moving average, but the 50 and 100 never crossed. Go back further. Tests of the 100-day average doesn't mean the uptrend's ending. At this stage, the upward trend is still in place, and this is still a pullback. Now, the price action will continue to evolve, and that overall bullish stance I still have may change when we have in the fullness of more price action being delivered. But at this stage, I think you've got to work on the base case being that the uptrend's still high. There's not a particular line in the stand level where, okay, if it touches this level, it changes, because we need to see how the price action evolves. Do we get a sideways range over several months and then breaks below the range? Well, then that could be a bearish sign. The moving average at that stage could be crossing, and we're now consolidating below moving averages. That starts to become a concerning or a vulnerable situation. But we could easily see the market go, rebound off this, pull back again, and then start to rally. So this is why I say wide trailing stops to see off consolidations. Because if this just goes sideways for several months and rallies again, you don't want to be getting out of your good positions. You want to be hopeful that the market will stabilise around its moving averages and move higher. At this stage, we don't have a breakdown. Big tech is pulling back, which is completely normal given how far they've run. And this has been an area where I've said, look, I'm happy to let profits run in a really profitable stock like NVIDIA, but I don't particularly want to be buying it at the levels we saw a few weeks ago. Hence, I was saying, look at the components, not the index itself. But yeah, look, at this stage, we don't have a breakdown. We've got to pull back.
All right, it's the pullback. I think you've answered my question there anyway, basically, in saying if the price action starts to go sideways, the EMA start to sort of cross up back down, then we start getting a bit more curious to the downside, maybe. But all right, let's have a look at the Chinese market and the Hong Kong market, I should say.
Yeah, so this has slipped further. So let me just extend.
So this could be a good example of this bearish price underneath the EMAs. They haven't switched though. The EMAs haven't switched.
Yeah, they're getting close, but like this has slipped further over the last week. Now testing this support around 17,000. As we've been discussing over the last few weeks, I'd rather just step aside from this market and focus elsewhere. It's lost its bullish structuring that was in place. Oh, look, going back maybe 6 weeks or so, this decline just continued. Now back below the moving averages, and so like if this were like. It's now below the moving averages, and the moving averages are rolling over. So it's getting itself into a vulnerable position. If say it started tracking, just traveling sideways in it like a narrow band for several weeks, and the moving average continue to roll over, that's when we say a market really does start to become vulnerable. Because once a market starts consolidating below the averages, the risk always is that then continues to break down. So that's where you can really start to see a change in trend. But just the fact that a market pulls back to the 100-day moving average doesn't mean it's going to break down. It's when it continues lower, as this one has, and now if it just can't get itself back above the averages, it starts to roll again, you can see how the structure starts to change. We go from trending above moving averages and consolidating above moving averages and rallying to getting on the wrong side of them. It's like during this period, during 23 into 24, that's where the market has decidedly turned negative because it's below and sticking below declining moving averages. That's when we stand aside. At the moment, I think there's better stuff to look at elsewhere. Same with China. Selling off after retested the moving averages a week or so ago. Starting to sell off again. Could stabilise here, but I'd rather just watch and wait for the price action to tell us to get interested again, rather than say, oh, look, maybe we pick up a bargain here and buy the dip, because for all we know, I think the odds start once you're below the moving averages and the moving averages are crossing. You've got to work on the basis that there's a reasonable chance that the rallies become shallow and the upward momentum continues. So until we see prices back above those averages, for me, walk away, find and there are other opportunities out there to look at. Stocks which are breaking out of ranges or rallying off moving averages. I think that's where the potential lies, not in trying to find the low in a market which just hasn't been able to go on with it. And not every excursion above the averages will develop into a big trend. That's just the way it works. Plenty will just flop like this one has. And it's okay. We've got risk management strategies. We pull money out. We put money into other stocks and sectors which are above those averages and rising, and we see which ones work. We let the ones that work keep running. The ones that aren't working, pull the money out and rotate it back into something which is working.
All right, fantastic. All right, let's get on to some viewer questions and tickers here that we can have a look at here. First of all, Michael says, finding good info and advice on the internet is like looking for hen's teeth. This webinar is one of those rare ones I found. Thanks, Michael. I'm glad we are not like hen's teeth. That's fantastic. Fantastic there. You can't short on AG, you can't short on the self-wealth platform. Sorry for that. How would you approach the ASX CCP, please? Let's have a look at CCP.
Yeah, let's just compress this and have a bit of a look at it. It's not like we don't have a dominant trend underway in this at the moment. Like it looked like in February that maybe it was starting to get itself going. I think we got a motion trader signal in February as well, as the price went from below the averages to above the averages, crossed, started to pull back to the averages. Everything was okay there. And then it's sort of done like what we're seeing in the Chinese market now. It's got back below the averages and it's been giving ground. So there's no reason to at this stage go in and want to buy it. That said, this could all still be part of a big basing structure, but basing structures are great, but then you need the momentum out of the structures to say, okay, now's the time to start accumulating the position. Encouraging to see this up day occurring as we film. It's entirely possible that we've had the initial rally, we've had a deep pullback, and now it's starting to turn higher again. But there's just, in terms of like entering a position, I wouldn't want to buy this here. If someone really liked it for whatever reason, I guess like one strategy would be to buy it at current levels. You can just have a stop loss below today's low. So that's still around 13%. It's been a decent up day. Look, I'd probably just leave this for now. If it was in my portfolio, I'd keep it for now, and I'd probably put my stop loss again just below today's low. If it's going to go, now's the time for it to go, I think. But if this rally quickly fades and it stalls and it comes back, then I'd probably just move on and look elsewhere.
Okay, fantastic.
It certainly does have recovery potential, but it's lacking the momentum at the moment. That's the problem. If it's a base, it does have that upside potential, but as I say, it's lacking the momentum, and a stock can lack momentum for years. It could go sideways for 2-3 years, then break higher. So I'm probably more interested when it breaks higher rather than trying to preempt that return of momentum.
Yeah. All right. Deborah says, great to be able to join you. I've learnt a lot from tuning in each week. So thanks, Deborah. And she wants us to have a look at, start off with FPH.
And that's great, Deborah. I'm so pleased that what we do is helps. This stuff doesn't have to be rocket science, but it's actually quite simple when you clip all the components together. But it's just being able to bring all those components about entry strategy, exit strategy, position sizing, and once you can do all that, then you've got a process. FPH. So look, there's an upward trend very much in place at the moment. This is drawn in from previous times, so it was a resistance point which it's now broken above. So if this were in my portfolio, I'd continue holding it. Wide trailing stop. It could just continue extending higher from current levels, or it could consolidate. Like I don't know, but I think the underlying trend is still higher. In terms of buying it, in terms of buying a stock that's been rallying, I prefer buying them when I get some sort of consolidation, which I can see it breaking out from. This doesn't really have that entry point for me at the moment. But if my entry point was at lower levels, or when it was breaking out, I'd be hanging on. Wide trailing stop, trends up.
Okay. What about PME?
Again, trends up. Let profits run. Not so keen to buy it at current levels. It is. We do have that bit of a consolidation. It's pulled back to the 50-day moving average. So it just look. It does seem to be. The thing with these trends is you just never know. Some of them just continue on and on and on, and this could be one of them. But I'd prefer looking at a stock like this earlier in its trend than at this point, even though it is pulling back to the 50-day moving average. I wonder whether there's more asymmetric looking entry points elsewhere. But in terms of if this stock were in my portfolio, I'd be 100% holding it because there's no reason to sell it. This trend could continue up. Particularly if I'm in at a good level. I just want to use that wide trailing stop and just let it go for as long as it's going to go.
Where has this stock been higher than this, or is this an all-time high?
I'd say that's an all-time high.
All-time high, right? So yeah, there you go. So there's no, you're never going to know where it's going to go, right? So hard to get in an all-time high sometimes, but obviously if you've got it, keep it, which is great.
Psychologically, it's hard to get in at an all-time high, but the thing is, all-time highs tend to lead to more all-time highs. It's like buying a stock at a 52-week high. A lot of people say, "Oh, I'd rather buy a stock at a 52-week low." But when I do the back testing on that, it's buying at a 52-week low is a disastrous strategy, whereas buying at a 52-week high is a profitable way to manage a portfolio. Just as simple as that. But rule: buy at a 52-week high. It has a tendency to make more money than buying at the low when I've done the back testing, and considerably more as well. Buying at 52-week low, I think, is often unprofitable. But yeah, look, there are 52-week high and 52-week highs. This one here has been running for a long time. So while, as I say, I'd be happy to let it keep running, I'd find it hard to buy it at this point.
Okay. All right. What about PDN, please?
So one of the uranium plays. So as with I think pretty much all the local uranium plays, they're below the moving averages, and the moving averages are crossing. In the last month, I've sold 2 uranium stocks, one being last week and the other being about a month ago. I've still got an ETF holding in the uranium space, but I've pulled that risk back as the uranium price, and then the individual stock prices have been turning lower. This could well be a low point. Like it's a bit stretched below the moving averages. It could well get a rebound. You could also say, look, it's also the possibility that there's like a zigzaggy type correction in place, and that there's a low sometime soon, sometime nearby. And this is what I had to do with my own play. Like I'll show you the stock I had last week. It was Bannerman. So I was in at Bannerman down here at $1.70 odd. Rode the great trend, and then it actually hit my stop loss, I think about 3 weeks ago, but I held on thinking we'd get a retest of the moving averages, but it kept slipping. Then I just had to bite the bullet last week and go, look, enough's enough. I've got to cut it, even though my feel is that at least an interim low is somewhere nearby. Because like what I'm doing is I'm balancing my regret. So at this point, if I was holding, there are 2 regrets. Well, if I'm holding, the regret is that it continues to sell off and it goes back to where I got in and lower. That would be a pretty ordinary regret. My other regret, if I sell it, is that it rebounds. So I've got to balance those 2, which is going to be my bigger regret. And for me, the biggest regret by far is to hold it and then see it continue to fall. That would be just a disaster in risk management. So I sold. Maybe that's a capitulation low. Maybe it's not. I don't know. But I had to move to protect capital and shut down risk. It just got to the point where it crossed the line in the sand, and the risk had to be shut down. You look at the uranium price. This is something I talk about in my strategy sessions on Friday. And uranium's in a vulnerable position. And I've been talking about this over the last 4 weeks, in that we've been consolidating below these moving averages. So we're talking about, like, when does the NASDAQ become vulnerable? it's like, you know, if we start seeing price action like we've seen in uranium, where it starts getting a shallow consolidation below declining moving averages, that opens up the risk window for a breakdown. We've got that in uranium. Now, will this be a false break and it quickly retraces, or will this continue to pick up steam? We'll find out in the fullness of time. But for me, for managing risk, it was exiting was the correct play, whether or not it rallies back or not. The correct play for me is I've got to manage risk. I've got to shut the risk down. It's just can't leave it open-ended saying, look, I'll just give it a bit longer, I'll give it a bit longer, I'll give it a bit longer, because before you know it, you play that game, you end up holding stocks that come all the way back. And that's very disappointing if you ever do that.
I like the way you said that, actually, Jason. Balancing, or asking those two questions effectively is: am I waiting for it to have a small pullback so I can either see it go higher or actually sell it at a little higher price, or does it go down to the point at which I first bought in, or even worse? And then obviously that's a worst case scenario. So I don't want to be in that. I don't want to be in that situation. So I love the way you said that. That was great.
So what would annoy you more? Say this is an entry point here. This is like a bit of a breakout point, probably a motion trader entry around there. So let's just draw a line across there, and let's do another one. Let's say, just above the moving averages. So what's going to annoy you more at this point? Say we're in this stock now. What's going to annoy us more? Is it going to be that, or is that going to be more frustrating to you, or is it going to be that? Now, either types of price action could occur. The latter, for me, that would be frustrating. This one here would be disastrous. So I'm choosing between frustrating and disastrous. So which one do I go with? Well, I go with frustrating, and I'll close out my position and protect capital. I'd rather be frustrated than just sitting here going, I can't believe I rode it all the way up and I rode it all the way down. So many people do that. Happens all the time, and they don't sell because they keep seeing where the stock was, and they say, well, look, if it just gets back a bit further, then I'll sell. And I did that myself to an extent, because just the way that the chart was structured, it looked like that rebound was coming, but it didn't come, and you just can't keep holding out for it, because sometimes the rebounds don't come until a lot more damage is done. So it's protect capital is number one, I think.
Yeah, and at the end of the day, I mean, you get out at that level. If you really need to get back in when it goes up, at least you got more capital to get back in with, right? So, like I said,
and that happens. That happens. You get out of stocks and they rebound, and you get another entry point. Sure, you get in at a high, get back in at a higher level, and that's it's just the way it goes sometimes. But I think often you're better off just getting back in at a higher level than just holding and hoping. This is a point where we need to be fearful, not hopeful. I think we need to be fearful that this continues down rather than hoping. Hope's on this side of the moving average. Hope lives on the left of the moving average. Fear lives on the right. And I think for a lot of people, they do it the other way around. They're fearful here, and they're looking to take profits, and they're hopeful here that we're going to turn back higher. I think play it the other way.
All right, let's have a look at Maku's question here. I note that the ETF for the S&P 500, ticker IVV, so let's just switch to that one.
So we'll use the Aussie listing for that.
Yeah, has not dropped to the 50-day moving average. So it's not dropped to the 50-day moving average, whereas the S&P chart has. Does that make sense? And then
it does, because this is the Aussie listing and it's not hedged. So this is a currency thing. So the Aussie dollar's been falling. So this is why it's interesting. What we can do. So this is the Aussie listing of IVV. Now let's compare that to the US listing of IVV, and we'll put it on a percentage scale. And So it depends where you So what's this telling us? This is so we've got the why is actually this example isn't playing out as well, it works. Yeah, it should be when it's compared on a percentage basis with the Aussie dollar falling. You should find that the Aussie held or the Aussie listed IVV should outperform the US listed one, because as the Australian dollar falls, holdings in US shares, the value of those is going to increase, because you sell the US shares and you buy back into the Aussie currency, you're getting back into a lower value. So you get that outperformance. And you can see the outperformance there. With TradingView, depends where you start your comparison from is going to make a difference. But generally speaking, that's why the local one hasn't pulled back, because the currency's been declining. I'll just quickly jump over to the currency, and here it is here. So look at this decline in the Aussie dollar. That coincides with the decline in the S&P 500. So it's been cushioning that decline in Australian dollar terms.
Yep, good. Well answered. And James has sort of said the same thing. I think it's because the Aussie dollar has declined against the US dollar. So, yeah. All right, let's have a look at SPR. And they've done well. Do we buy more?
Not a buyer. I'm not a buyer up here because this is quite stretched above the moving averages. It's been a terrific trend. Let's just compress it. Where it's come from? Yeah, great heights. Yeah. Okay. So yeah, like initial entry signals for this potentially back when the averages crossed back in July 23 and started breaking higher. Great example of why we let profits run. You just don't know how far they're going to run. This is now getting stretched above the moving averages. So yeah, I'm inclined not to want to be buying a stock when it gets so stretched. What I can do, I can put on this indicator. This measures the percentage above the 50-day moving average. It's this one here. Let's have a look at this. So 50-odd% above the moving average. And what's in this, and you just look at so it's at the point where this is about as stretchy as this tends to get. Now anything can happen, and this time can be different, and it can get even more stretched. But generally speaking, you tend not want to look. This one here didn't lead to a big, like it. The moving average closed in because the moving average started to catch up. So it doesn't necessarily mean the stock's going to fall, although often it tends to be a case where the stock does pull back. As you can see, there's been several of those. Even this one didn't get so stretched. So I'm inclined to say, look, it's stretched above the moving averages. I'm happy to hold it, but I don't want to add to the position at this point. I'd rather wait for a consolidation, maybe, then assess it. I like holding stocks which are stretched. Don't mind doing that, wide trailing stop, but I don't like chasing stocks that are stretched. I'd rather just be happy with the profit I'm making and let that run, rather than increasing my average price by adding to a stock at what appears to be a pretty stretched level.
All right, let's have a look at WHUR for James. He's got a few friends lurking around that want to know more about it.
Is this Woolworths we're talking about?
Yes, Woolworths.
So just compressing it to get a little bit of a look. Look, hasn't done much really since mid 21. And let me just quickly put this onto onto a weekly. Yeah, like it's interesting when you look at it on a weekly. This big upward move from the 2016 low, big upward move. You could say, is that a zigzag? Is that a zigzag decline? Is the last 3 years just a big corrective move to what was a multi-year bull market? And like big bullish phases, as we've seen at various times in Woolies, have led to these lengthy consolidations before upward momentum has resumed. There's another period going back into 2000, big move. Then you got a multi-year consolidation. So it does. This has happened before. So this is a problem when you just look at something on like in the last 2 years and you go, oh well, look, this stock's a dud. It's just been declining. Put it into perspective, see where it's come from, and then you can see the correction does fit with that bigger bullish phase it had been through. So just looking at it on a daily basis, gone from below the averages to above the averages are crossing. So starting to get a positive structure to it, which could support higher prices. Often when we see prices go from above to below, we get some sort of consolidation. And then for me, the breakout of that consolidation can often be a good entry point. So I probably wouldn't be a buyer today. Instead, I'd probably be watching the price action. And often we get some sort of price action like that where the averages catch up and then it starts to break higher. So it's this secondary break higher. So it's had a bit of a run. Quite normal for now to want to have some sort of a consolidation of that move. How it looks, whether it looks like that or something else, we don't know. But I'd be looking to see, like, does it consolidate? What's the consolidation look like? And then do we get a secondary break? That's when I become interested in that in this stock. And it's certainly one which could do that. It's one I think which is worth watching. Not quite for now, but it could be getting close after a few years of being, nothing to look at. And I think we just lost Rog. So here he comes, you're back.
I'm back. Sorry, I'm not sure why internet just dropped out. What are we at? We're still at Woolworths. Are we on to the next one?
Just wrapped up.
All right. There's a question here from Bob. What is your time frame?
Well, we've lost Roger again, so it's a question about time frame. Oh, you're back.
What is your time frame to deterring the upwards momentum, Jason? I'm not 100% sure what that means, but
I'm using 50 and 100-day moving averages. Like I could use shorter averages, and they can be great too. But I'll get more signals, so I've just got less stuff to filter through if I'm using 50 and 100-day. There'll be more false signals I've got to consider if it's if I'm using, say, 10 and 20 days or 20 and 30 days, whatever it may be. So I'm using that 50 and 100-day moving average combination. Like it doesn't give you the earliest entry signal, but you don't need to get in at the low to do really well. For me, I'm looking for stocks which might do well over maybe the next 1 to 3 years. That tends to be that medium-term time frame that I'm after, and which my wide trailing stops can handle. And that 50 and 100-day moving average, they're not magic moving averages by any stretch. They're just I think you've got to use something. And for me, it's the 50 and 100. It's that good mix of getting in reasonably early, but also filtering out a lot of the noise that you get when you use shorter term or faster moving averages.
All right, I hope that answered your question, Bob. If let me know if it doesn't. Otherwise, we can always revisit it next week. I'm going to finish you off on one stock for my curiosity, please. That's SDV, Jason.
Yeah, this is an interesting one. It came up. I was talking about in the strategy session a couple of weeks ago, and it turned up in the signals. I've been in the signals a few times. think we got the third signal maybe yesterday or the day before. Yeah, look, this is a positive chart structure. Below the averages to above, and this is what I was talking about with woolies. Like often when you go from below to above and the averages cross, you get the initial run and then you get the pull back into the moving averages. So that's the sort of price action I was drawing on the woolies chart. It doesn't always play like this, but often it does. It's just one of the setups I look for. I just really like this setup through here. It provides something which I think you can get a nice asymmetric entry in that I like to buy the breakout from these sideways ranges, and then you can have a relatively close stop loss, and then you see where they go. Some of them can go a long way. So you're getting a relatively low entry point to a high potential setup. So like every situation isn't going to be profitable, and that's okay. We can have plenty that don't play out, lose a little bit each time, and then a few times make a lot. And so that's how you play an asymmetric game in the markets. So with this now, it's a case of it's getting a bit away from those moving averages. So I've become less keen to want to add to a position or enter a position just now. I'm more inclined to say, look, I want to be in a bit earlier and then let profits run. Where we are now, I'd be wanting to wait for another consolidation, see what the consolidation looks like, maybe buy a breakout from the next consolidation for an entry point. But yeah, look, this is one of those ones which it could double from here, or it might, could peak today. But we can, if it peaks today and pulls back, we can manage that risk with our trailing stop. If it doubles, great, we can stay and let profits run. So this is one I'd be wanting to hang on to.
Okay, perfect. Thanks, Jason. I think we're wrapped up for today a little bit earlier than what we normally would, which is great. So you get an extra 15 minutes in your day, and everyone else does as well. Thanks a lot, everyone, for attending. Thanks for coming along with your questions. Thanks a lot, Jason, for you and all your lovely, great answers. Once again, message of the day is focus on a system and a process and all that, and everything will come because there's plenty of opportunities in the market to take advantage of, right? So even on the down days, right? So Jace, I wish you all the best and have a great week ahead, and everyone else too. Have a great one.
Roger, you too, and viewers, thanks for joining us. Thanks for some great questions. That was fun. Look forward to next week.